In this video, we're going to be doing a deep dive on Intuit. This stock has gone down more than 50% from all-time high. I think it's down close to 50% from the 52-week highs. So it has been bouncing back. The lows were at like 250 and the highs at 800, which was this very steep drop, and it happened very quickly in the span of around 12 months. Bounced back a little bit, so I thought I should make a video because I still think it's a huge opportunity here in Intuit. So this company has like 4 parts: TurboTax, QuickBooks, Credit Karma, and a smaller part, Mailchimp. So right off the bat, Intuit is much more than TurboTax. A lot of people know Intuit because of the taxes, but that's not why I invest in Intuit. I invest because of the accounting software, the QuickBooks part, which is the crown jewel of Intuit. But yeah, the company owns a group of financial platforms that sit inside the daily workflows of consumers and also small businesses. And QuickBooks is in the center of Intuit. QuickBooks handles accounting, invoicing, payments, payroll, bookkeeping, and financial records. Over time, all of those functions can be connected inside the same system, so it makes QuickBooks much more than just a simple accounting application. Obviously, Intuit also owns TurboTax, Credit Karma, and Mailchimp, so the company operates across taxes, personal finance, and small business accounting. But in this video, we're going to break down exactly how Intuit makes money. First part, we're going to talk about TurboTax. We're going to go deep into each separate part. And at the end of the video, we're going to run the numbers in stockanalysis.com. And we're going to check everything, including the valuation. And we're going to see if it makes sense to buy Intuit at today's current valuation. Okay, so the first part of Intuit that we're going to be talking about is TurboTax. This is basically Intuit consumer tax engine. It takes a process that is complicated, annoying, and high stakes and turns it into software that walks the customer through the return step by step. So the customer enters an income and whatever else applies, if he owns a house, if he has kids, if he is married, if whatever. And then TurboTax handles the tax logic underneath. So the important thing here is that not every customer is equally valuable. Someone with one salary and a very simple tax return has plenty of alternatives and can often file for free. The more complicated the financial situation comes, the more useful TurboTax becomes. So business income, investment, rental properties, multiple income streams, deductions, capital gains, all of that creates more complexity and more willingness to pay for this type of software. There is also a trust element here. Taxes are not like choosing a music app. This is not like choosing Spotify over Tidal or whatever. If something goes wrong, you are dealing with the IRS, okay? So you don't want that headache on your head. You don't want to file your taxes in a wrong way. So someone who has once already used TurboTax for years and has their previous returns stored in there, understands the workflow and trusts the software. There is some real stickiness there. So there is some kind of moat based on trust. But obviously, this is completely separate from QuickBooks. TurboTax is a strong brand and has a very large customer base in the US and Canada, but the switching costs are much weaker. It's mainly used once a year, so this is not a recurring type of monthly recurring costs in the software. There are cheaper competitors. All accountants are also an alternative, and then even the government filings can make it easier and free for you to file your taxes. So in 2024 and 2025, the government had like a program where it helped you file your taxes for free. But even during those years, Intuit grew this part of the business by 7% and then 10% subsequently. So people still choose Intuit because there's real value offered. But you have to understand that this has already reached its total addressable market. The customer base is shrinking. This is losing about 1 or 2 or 3% per year, something like that, of its customer base. But this is still growing because there are 2 parts of TurboTax. It's the classical TurboTax app, and then there's the live assistance feature. which customers pay more for, and they get live assistance from an operator from Intuit, and that operator and or agent, they help people file. It makes the whole everything go smooth, the whole operation go safe from the IRS basically, and people seem to be willing to pay a little bit more for that. So that part of the business, TurboTax Live, has been growing for about 47% in 2025, and it's past $2 billion in revenue. So there's real growth in there for sure. But what you need to understand that this is a cash cow. At some point, they're just gonna squeeze out all of the milk from it. So in terms of growth, and then it's just gonna remain kind of a flat amount or slightly declining in total revenue, type of a situation where the Intuit is just gonna milk this TurboTax for the cash cow that it is, and so it's not a dying business, but it's certainly has reached its peak, extremely mature, and has turned into a cash cow basically. Nothing wrong with it, but it's just something that you need to understand. This is not the growth engine of Intuit overall. What were we going to be talking about next? QuickBooks. Now that's what I am interested much more in. All right, so QuickBooks. This is the crown jewel of Intuit. And this is why I basically invest into this company. This is where the business becomes much harder to replace. The moat, the vertical moat of Intuit, is represented basically by this part of the business, QuickBooks. So a small company can start using QuickBooks simply to keep track of revenue and expenses. So it's an accounting software, but over time, the software can become the central financial record of the entire business. So once the accounting is inside QuickBooks, everything pretty much starts connecting to it. The invoices are created there. Customers pay through QuickBooks. Payroll can run through it. So QuickBooks will have competitors such as all of the big payroll players: Paychex, Paycom, Paylocity, even ADP. So expenses are categorized there also. Taxes are prepared using the same financial information. So the business owner, the bookkeeper, accountant, and the employees, they can all interact with different parts of the system. That's going to create a much stronger switching cost than a normal software subscription, of course. The customer is just not going to move files to another application just like that, even if it offers them a lower price, because years of financial history are sitting inside QuickBooks, and the accounting structure has already been built. Employees understand the workflow, and the accountant may already be working inside the same system. So this is one of the moats that Intuit with QuickBooks has, because accounting is one of these areas where businesses really do not want chaos. If the books are wrong, then payroll is wrong. Taxes become more complicated. Invoices get missed. Cash flow becomes harder to understand. So eventually the business owner has a real operational problem. QuickBooks sits very close to the financial control plane of a small business. Okay. The important part to this is that Intuit can keep adding services around the accounting system. So payments are a very good example. Once QuickBooks already knows who the customer is, what invoice was sent, and how much money is owed, letting that customer pay directly through QuickBooks is a natural extension. He doesn't have to use Stripe or whatever else payment system. So Intuit can then take a small piece of the payment volume instead of relying only on software subscription. So also payroll works in the same way. The accounting system already knows the employees, the expenses, the taxes, the financial records of the company. Adding payroll makes the ecosystem more useful, but it also makes leaving QuickBooks more painful, because now there is another mission critical workflow attached to it. Okay, you cannot mess up payroll. Okay, you cannot stop paying your employees. Okay, you cannot just tell them, yeah, figure out yourself what you're gonna do in the next couple of weeks, because we're switching accounting software, so we're not gonna be able to pay you until we implement something from Paychex or whatever. So this is why I think about QuickBooks less of an accounting software and more as financial infrastructure for small businesses. Basically, the accounting ledger is the foundation, and then Intuit keeps adding more workflows to that foundation. Every additional workflow increases the value of staying inside the ecosystem. And now I want to talk about something else that strongly reinforces the moat, which is a strong accountant and bookkeeper layer around QuickBooks. A business owner may not even be the one who is making the software decision. The accountant already knows QuickBooks and works with other clients using QuickBooks, so he's just going to recommend that certain business owner that he also stays on the same platform. So more often than not, that business owner is not going to do research. Oh, am I going to use QuickBooks or Xero or Sage, whatever the name is, Sage 50, I think, for the Sage software. He's just going to go with QuickBooks if his accountant recommended QuickBooks and if his accountant knows how to work in QuickBooks. So that kind of creates a layer of institutional embedding that competition has to overcome, basically. So competition exists, Xero, Sage, and these are also companies that are publicly traded, and these are companies also that are part of my investable universe. I can invest in them, but I choose Intuit right now because it's gone down a lot more than it should, a lot more in valuation than these other companies. And Xero and Sage are, I wouldn't say pure play accounting software, but yeah, they don't have some of the other stuff that Intuit has. So there is also competition when it comes to certain features, like we talked about payroll, ADP, Paychecks, smaller companies, and then payment companies can compete on the features of QuickBooks, such as Stripe and Square. Then plenty of smaller accounting products. They can attack different parts of the stack, but that's also the point. A competitor can be better at one individual feature without replacing the entire QuickBooks relationship. So a business might just use Stripe for payments and ADP for payroll and still keep QuickBooks as the accounting system underneath everything. So a system of record position is extremely valuable, of course, because the accounting data is where all of the different financial activities eventually come together. The next step for Intuit is pushing further upmarket with its enterprise suite. So historically, QuickBooks has been strongest with SMBs, small to medium-sized businesses, but eventually those businesses that Intuit serves, they are becoming large enough that they just have to adopt a traditional ERP, and they might go with something like NetSuite from Oracle or Sage, Enact, or some other traditional ERP system, something from SAP, I don't know. But this has been historically a big problem for Intuit because they help SMBs grow, and Intuit is with them along the way, and then they eventually lose that customer. So, but now they have an answer for that problem. They have released something that's called Intuit Enterprise Suite, which will help migrate these SMBs that need a bigger ERP, that have outgrown QuickBooks. They are basically capturing these customers and bringing them into their own ERP style, basically, of it's not a traditional ERP, but it is a similar type of solution for these companies. So what about AI? AI probably strengthens this model more than it weakens it, because an AI agent can help create invoices, categorize transactions, answer questions about cash flow, reconcile accounts, or automate bookkeeping, but the AI still needs reliable financial data. And an authoritative system underneath it. QuickBooks already owns that underlying accounting record. So the interface might change dramatically over time because of AI, but the underlying financial system does not become unnecessary just because LLMs exist or AI features exist. If anything, better automation coming from AI can make QuickBooks more useful, because more of the boring accounting work can happen automatically while the company still controls the financial data and the workflows underneath. So this is why QuickBooks matters so much to the Intuit thesis. TurboTax is a strong consumer franchise, but it's shrinking. And Credit Karma has useful financial distributions. We're going to talk about Credit Karma next. But yeah, QuickBooks is the part where Intuit has the deepest workflow integration, the strongest switching costs, and the clearest path toward becoming the financial operating system of the small business. And not only that, it just recently added a growth engine to this entire thing, which is the Enterprise Suite. Okay, so Intuit Enterprise Suite is basically the next step above QuickBooks. QuickBooks is extremely strong with small businesses, but eventually some customers become too large and too complicated for normal small business accounting software. They start having multiple entities, more and more employees, more locations, more complicated reporting, and eventually they begin looking at traditional ERP systems. Intuit is not necessarily trying to stop these customers from leaving. They just want to retain these high valued customers, okay? Because Intuit wants to offer a lot of value with the accounting software, with QuickBooks, and of course they want their customer to grow and have success. But that means that also that eventually those successful customers are going to leave and stop paying into it. So Enterprise Suite adds things like multi-entity accounting, more advanced reporting, workforce management, project workflows, spend management, and deeper financial controls. So instead of a growing QuickBooks customer eventually graduating into something like NetSuite from Oracle or another ERP, Intuit wants to keep that business inside its own ecosystem. So this could be very important for the future because it extends the lifetime of the QuickBooks relationship. Intuit already has the accounting history, transaction data, payroll information, payments, and financial workflows of the customer. So if that company grows from, let's say, 20 employees to 200 employees, Intuit does not want to hand that customer over to someone else exactly when the account becomes much more valuable. So it also pushes it pushes this company further into financial control plane of the businesses. So instead of only handling accounting, Enterprise Suite is obviously gonna behave like an ERP. It can connect multiple companies, employees, project payments, reporting, and eventually more operational workflows inside one system. So Intuit is explicitly targeting the mid-market right now, and management has made becoming a major mid-market platform one of its strategic priorities. So eventually it's going to compete with Oracle, SAP, and the big players. Hopefully that's what I wish, that it becomes from of Intuit with this part of the company, because if I'm going to be investing for the long term, this is basically the growth engine of this stock. So the advantage that Intuit has right now is migration. A company already using QuickBooks that does not necessarily have to rip everything out and start all over again when it becomes more complex. Intuit says that historical QuickBooks data can remain intact when moving to the Enterprise Suite, and that gives Intuit a natural path to move an existing customer upward rather than acquiring every enterprise customer from scratch. So Intuit, if Intuit executes properly, QuickBooks is going to stop having such a clear ceiling, and then it's just going to mean that the customer can start with QuickBooks from a tiny business, grow into a much larger company, eventually grow into an enterprise, and potentially remain inside Intuit for much, much longer. And also that increases switching costs, of course. It basically makes the moat of Intuit much deeper, kind of like traditional ERP systems, because migration is close to impossible when the company gets very large. So it also gives Intuit a much larger market to attack, which I'm very happy about. All right, so Credit Karma. This is basically a financial marketplace. Consumers use it for free. They get credit scores, credit monitoring, loan offers, credit card offers, and other financial tools. And the consumer is not really the customer. Banks, lenders, and credit card companies are the customers. They pay into it. So they pay Credit Karma when it sends them a qualified borrower or a card applicant. So that means Credit Karma makes money from matching consumers with financial products. The advantage here is data. Credit Karma knows a lot about the consumer's credit profile. It can estimate which credit cards or loans that person is likely to qualify for. That makes the recommendations more valuable to lenders. Instead of a bank advertising randomly, Credit Karma can send it to someone who already fits the profile that financial institution wants. So there is also an interesting connection with TurboTax. TurboTax understands income, taxes, employment, investments, and other financial information. Credit Karma understands credit and borrowing. So together, Intuit can build a much broader picture for the consumer's financial life, basically, that can make the matching engine better over time. But Credit Karma is also more cyclical than QuickBooks. So when they slow down the lending, when they approve fewer loans and credit cards, when that happens, Credit Karma can suffer, even if its user base is still very strong. So this is not the same kind of non-optional business as QuickBooks. It's much more affected by the recessions and the strength of the economy, basically. So Credit Karma is more of a distribution platform for financial products. The moat comes from scale, consumer data, brand, and the ability to match lenders with the right consumers. It is a useful business, but it depends much more heavily on the health of the credit market than QuickBooks does. Let's talk about Mailchimp real quick here. This is basically Intuit's marketing business. It started mainly around email marketing, but today it includes some other stuff such as marketing automation, customer management, campaigns, segmentation, and tools that help businesses find customers and keep selling to them. The strategic logic behind buying Mailchimp back in 2021 was pretty understandable. QuickBooks sits on the financial side of the business, accounting, invoices, payments, payroll, and then Mailchimp sits on the customer acquisition side. So Intuit wanted to connect the entire loop and help a business find a customer, make that sale, collect the payment, and then record everything inside QuickBooks. The problem with Mailchimp is what Intuit paid for it. They bought Mailchimp in 2021 for $12 billion. They grossly overpaid for it. They bought it with 5.7 billion in cash and another 6.3 billion worth of Intuit shares. So they also borrowed 4.7 billion to help fund the cash portion. So not such a great move. Mailchimp generated about 750 million of revenue during the first 12 months after the acquisition. So paying 12 billion for that's like, I don't know, 25 times revenue, price to sales. That's an enormous price for the type of business. And after the integration, the problem was it did not produce the beautiful QuickBooks plus Mailchimp machine that the story suggested. Years later, Intuit is still trying to lay the groundwork for better Mailchimp growth, but they've had a lot of problems with it. They also tried to sell it off, but they couldn't find a buyer. So right now, they stopped investing into Mailchimp. It is growing slowly. It has a lot of competition. The moat is much, much weaker, obviously, than QuickBooks. Marketing software is just very crowded. Businesses can choose from HubSpot and there are plenty of other platforms. So moving your email campaigns is a little bit annoying, but it's nowhere near as dangerous as replacing the accounting system that holds years of financial records, payroll information, and tax data. So this is the big distinction. QuickBooks is closer to a system of record, much closer to a traditional ERP. Mailchimp is closer to a feature-rich marketing tool. So Mailchimp can still become valuable if Intuit manages to integrate it, but right now it doesn't really seem like it. It's not entirely stupid. The acquisition is not a complete fail. The strategic logic is pretty clear. The problem was the price and execution. They didn't execute well on that, and they paid a gigantic amount of shareholder capital, okay, for a business with a weaker moat, basically. And years later, they are still working on extracting the value that was supposed to justify that price. And at this point, we're just gonna wrap it up as a loss. We're gonna hold the bag in Mailchimp, basically. We're gonna invest into it. I mean, it is what it is, but yeah, sometimes a lot of things can go perfect for a company, and you can get it at a very low valuation. But this Mailchimp acquisition with Intuit has been, in my opinion, not a disaster, but a big mistake. All right, so we're on stockanalysis.com, and as you can see here, the stock price over the last 5 years, I mean, it's just looking very, very ugly. Very sharp falling knife since basically last year, summer of 2020, 2025. It had a drop of like 67% or more, like 70%, I think, and quite a violent rebound since the bottom. But I still think it's a nice entry point. I wouldn't, I mean, Ford P 14 only, P ratio right now of 22. It's very, very low for the type of business that it is. We're going to take a look at the numbers, but yeah. As you can see, all-time graph, beautiful, growing exponentially, which is what should happen with high growth, sustained high growth. Market cap right now, 101 billion. Also pays a dividend, which I don't really like. I hate dividends, but I mean, it is what it is. This is a mature enough company, and like we talked about, it has the TurboTax part of the business, which is already a mature cash cow, and I guess they can pay a dividend just based on that. But yeah, the graph here from the revenue and profits grows beautifully. Even this is over the past 10 years, since 2016. They were doing 4.7 billion in profit more than 10 years ago, and now they're doing more than 4 times that, 21 billion. Now this is trailing 12 months. It's probably going to be even higher by the end of the year. So they are still growing massively. I mean, they are quite a mature company and they're still growing. It's consistent double digit. Look at this. They have not had a year in the past 10 years where they grew less than 10%. Amazing. Beautiful. Intuit is a very, very strong company. Just looking at these sustained revenue growth numbers. So let's take a look at shares outstanding. Pretty much flat. Increased in 2021 because of the acquisition. They dumped Mailchimp on our head. They diluted us shareholders. I wasn't a shareholder back then, but still, I mean, this you do not want to see this. Yeah, the stock-based compensation is big. They do buybacks, but it's just to cover the stock-based compensation. It's not really reducing the share float. The shares outstanding is pretty much staying flat. Gross margins used to be higher 10 years ago. Business has changed a little bit, but still we're at 80%. Very, very high, normal for a software company. Operating margins was around 29% before they acquired Mailchimp, dropped down, and since then they've been on a recovery path. So this is going to be going up and up at least until we hit like 28%. I mean, we're already kind of there, but I think we can do even better if, of course, if the management executes well on QuickBooks and they also implement the NetSuite successfully. So over time, this can be even a higher net margin company. FCF, 37%, combined with 15%. I mean, for the rule of 40, this is hitting around 50. Beautiful, more than 50. Let's take a look at the balance sheet. Cash and equivalents. So yeah, they had a bunch of cash back in 2020 before the acquisition. That's what companies do before they prepare for an acquisition. They dilute a little bit and they keep more money of the free cash flow into the bank. Dropped a lot since then, next year 2021, but now we're trailing 12 months, we have about 5 billion in the bank. Let's just say 4.5% of the market cap, we have it in cash and equivalents, okay? Goodwill, and yeah, this was just not something ideal. Me as an investor in my own investment framework, I obviously much prefer that the company builds something internally and grows organically. But Mailchimp was just a feature that you could have built from scratch. It's not like Synopsys buying Ansys. Okay, it's something. It's just a feature. Net cash 0. They were negative 4 billion. They increased the cash pile a lot since then, and we are at a total debt at 7 billion. They reduced quite a bit of the debt. Net cash 0. So there is absolutely no risk of this company ever going bankrupt in the next few decades, probably. Net income growing very nicely from about 1 billion 10 years ago. Now we're looking at 4.5 for trailing 12 months, which is perfect. But the problem that I have, the only red flag and the only problem that I have is the stock-based compensation. This is just obscene. I mean, it started to grow a lot since 2021, especially after that acquisition. Probably the employees of Mailchimp were getting compensated a lot and they retained that structure, which I hate. They need to sell out. They need to sell off Mailchimp, in my opinion, if they can. And me as a shareholder, I would be very, very happy if we get rid of some of the stock-based compensation. because Mailchimp is a very weak business inside Intuit. And look at this. I mean, the stock-based comp increased from 400 million in 2020 up to like $2 billion. I mean, it's just obscene. And this is, I'm just gonna put it as a red flag. I hate this stock-based compensation. This is it's like a rake in the casino. Repurchases of common stock. Now, at least they do quite a bit of repurchases. Trailing 12 months, they've been doing 5 billion. So the total amount is about 3% in shareholder yield for us, because the stock-based comp is 2 billion. This is 5 billion. The market cap is around 100 billion. So 3 billion on top of 100 billion is around 3%. So we're getting around 1.3% in dividends plus 3% in stock buybacks. And this is not going to be, they have increased the buybacks because the stock price is in the toilet, and the management is saying, hey, we're going to buy back more stock right now because we're getting it cheaper. But yeah, my main concern here is with the stock-based comp. If this continues to go higher and the repurchases are just to cover up the stock-based comp, we're not going to get any type of value as a shareholder. We're not going to get diluted either, but we're just going to rely on the top line revenue growth, which is in the teens right now, 15, as we have seen, 15%. But let's just say it drops to like 13, 12, 11. You're just going to have to rely only on that instead of also getting paid a dividend and also getting a return from the EPS increase. Because buybacks, obviously, they just increase earnings per share. They retract the shares outstanding, and you get more earnings for each share. So that's how you're going to grow with buybacks. But here, in this case, the stock-based compensation is just too big. That's the only red flag I found with this company. And considering the moat and the quality of the company, it's acceptable for me. I'm going to accept it. Obviously, this is going to be part of my investable universe. It's not perfect, but I'll take it. And I'm very comfortable buying and owning it for even the next 5 years. Not a problem with it. So forward PE, let's take a look at the valuation here. Forward PE, this is non-GAAP, of course. So forward PE is not really going to be 13.8 like it's shown here. The GAAP PE, the trailing PE next year, it's going to be probably like 15, because this doesn't take stock-based compensation into account. So forward PE is showing here 13, but you have to be careful with this number. Don't just look at this number and say, oh my God, it's so low for such a high growth. Always take into account stock-based compensation. It used to be trading back in the mania of 2022 at like 55. It's come down tremendously since then. That's like 80% drop in forward PE. P ratio down to like 22. 10 years ago, it was trading at 30. And as you've seen back 10 years ago, I mean, the growth rate wasn't crazy. I mean, let's take a look by year. It had the same amount of growth. I mean, 12, even 10%, 15, 12, 13. Now we have the same kind of amount, 13, 13, 15, 15. But the valuation is much lower. So I would argue the quality is even higher right now for Intuit, because QuickBooks has been growing since then, since 10 years ago. It's on the cloud now. I'm gonna go into KPIs and show you QuickBooks. But yeah, in terms of valuation, it's very, very attractive because the moat has been growing. Actually, it went deeper, has not necessarily widened. But yeah, the ROIC, this was crazy. Before the acquisition, which has destroyed the returns on invested capital, they were 116, 100. And these are obscene numbers. These are absurd. And obviously plummeted down to like 12. I mean, we are on a recovery level. But even 20%, this is massive. ROIC of 20% is decent and good for high quality software business. It's not crazy. My Adobe has like 60%, but it's just good enough right now. It's gonna keep on growing and growing as they move on further from the Mailchimp acquisition. So FCF yield 7%, dirt cheap compared to its historic level. Also the S&P, which is like 2% right now, or maybe 2.5. So this is like 3 times more than the S&P, which is basically saying you get $2 more on top of the $1 you would receive for buying the S&P right now. So you put $100 into the S&P 500, you would get, let's say, $1, and with Intuit you would get 3 for the same kind of value amount. So the dividend yield, yeah, I'm not very excited about dividends in software, but it makes sense because they have TurboTax, like we discussed about. Total return for the shareholders, as you can see here, is not very exciting. It is what it is. The stock-based compensation is always a plague. This is basically like a fraudulent part of the US stock market. It's found pretty much everywhere. There are very, very few companies, high-quality companies in the US stock market that don't offer obscene stock-based compensation. But yeah, let me just show you QuickBooks Online accounting revenue. Back 10 years ago, it was doing 450 million. Now it's doing more than 10 times that, 11 times, let's say, by the end of the year, which is going to be perfect. I mean, this is high sustained growth, perfect, very highly recurring subscription revenue. I mean, we're looking at Q over Q, quarter over quarter. This is perfect. So yeah, that was pretty much it for Intuit.